All right, we get back in. All right, everyone. So really, this slide is really critical because this gives us the reason why we need to buy properties in Australia, particularly. The data that you see on the screen is from the government's own treasury. That's New South Wales Treasury data. You can see here where my cursor is. And what this data is saying is people who do not buy properties, when they retire, their income is really low because they have to retire on pension. They don't have enough income coming in. And the average income the government has said is around $23,000 a year. Now, I don't know many people who can live on $23,000 a year. That's scary. Compared to that, people who own properties, average income, this is not the highest to the lowest, their average income is $56,000 a year, which is more than double of people without properties. But what is really alarming, what is where the real difference is here? If you look on the other side, the wealth, how wealthy people are who have invested in property or bought a property compared to those who do not buy property all their life. And there are a lot of people out there. There's over 50% population who do not own a property. These people have to rely on this superannuation or some of basic investments they have in the stock market. Their average wealth sits at around 78,000 compared to a person who owns a property. He's sitting at 1.4 million because with a great passage of time over the 10, 15, 20 years, the property appreciate because of the cost of things going up, inflation, and market movements. So that's what the government is saying to us. Now, as a company, we continually scan the markets to see what's going on. And we carried out a research with a whole array of experts, people who are economists, accountants, actuaries, mortgage brokers, real estate people. And we ran multiple sessions. And this is where we have come down to in terms of market dynamics. What's negative in the market right now? Inflation. That means the cost of things going up. Sentiments. There are certain people who are a bit negative about the market because of, the global sentiments, the war or slowdown in China and stuff like that. There's cyclic correction happening. Markets went up quite a bit, so they're stabilized a bit. So there's a cyclic thing that's going on. And interest rate. We've seen interest rate going up yesterday as well. And Reserve Bank of Australia has done more than enough, I believe, in the interest rate space. Maybe there's one or two more interest rate hikes that are bound to happen. But you can see with the last few interest rate hikes, it hasn't really caused that kind of panic in the market. The property prices haven't dropped. I'll be surprised if any one of you on the Zoom today can tell me that properties which are need-based properties, I'm not talking about $5 million mansions. I'm talking about need-based properties in the price bracket of, let's say, 500,000 to 650, 700. Have they really dropped by 20%? Not really. I don't think any one of us can get a property which was worth 700,000 for 550 just because of the interest rate. That hasn't really happened. Those properties are still moving very fast and selling quickly because of the reasons given above here. Unemployment is so low. It's the lowest in last half a century. That's crazy. And we have so many more jobs advertised as well. So there is still need for more people to go into employment. Where are we going to get these people? So that means everyone who in Australia practically has got a job right now. The rentals are increasing because of the very simple reason, lack of supply. We are not building enough properties in New South Wales as we need. Hence, there's a stark increase in the rental. Anyone who's renting out there at the moment, I'm sure they're feeling it, that the landlords are calling up to increase the rents and so forth. Not many asset classes. What it really means is that people who have, let's say people stop buying properties, what are they going to do with their money? Where are they going to put the money? Are they going to put into stock markets, which are more fickle? Are they putting in crypto? Are they leaving that in bank? Because if you leave your money in the bank right now, this is what's happening. Bank might be giving you 2% interest. Inflation is around 5 to 6%. So that means your money is buying 4% less next year than this year. So you're really losing 4% on your capital if it is sitting in the bank and not earning any kind of return on. Increasing construction costs. These are impacting a lot of builders right now. And that's the reason it's a positive, because when the cost of construction goes up, that means the developers are naturally going to charge more for the product. And that means the future buyers who are coming after 1 year or 2 years or 3 years to buy have to pay more for the same property. Government stimulus. Why are we talking about government stimulus? Because property market is a very large, property market is very large in size. So large, it is a $10 trillion market. It is close to $10 trillion market. And government can't let such a market go down very crazy, because that'll cause a lot more issues than just the property prices dropping down. And the beautiful part is there is some data available. The total LVR, those of you who are enthusiastic about the property data and the market research, the LVR, which is a loan value ratio, simplified it. When you go and buy a property, you go to bank to borrow money. You borrow maybe 80%, 90% of the value of the property. That's called LVR. The total LVR of the complete Australian property market is sitting at 21%. That means $10 trillion market, the outstanding loans are only 2.1 trillion. So it's pretty much very safe over there. And immigration, major game changer. We got over 500,000 people sitting out there to arrive in Australia. Large chunk of these people are going to enter Sydney because of the opportunities. That means all-time high vacancies for job and more businesses flourishing out here. It's a economic hub or economic powerhouse of Australia. And these people coming into Sydney, they're going to cause increase in rental or demand for properties, which will cause, obviously it'll actually create more demand and it'll cause property prices to go up. Now, that's something basic for all of us to look at. But just to give you a bit of background as to why we are doing this, why we are researching the market, why we're looking at all of this stuff. Because as a company, Quarter Acre, we are involved. We are involved very heavily with the developers. These are developers who are spending hundreds and hundreds of millions of dollars to buy big projects. And we provide consulting to them. We look at data, we look at market intelligence, we do a lot of modeling for these guys. So when these developers are buying land to construct apartment buildings, which are worth $400, $500 million projects, they want to be careful. Just like me and you, when we are buying an apartment or a house, we want to be careful that we're paying the right price, we're buying in the right area, more demand, less supply, government infrastructure, all of that stuff. Similarly, a developer has to be very careful when he's investing such large quantum of money. And at Quarter Acre, we provide them the consulting. In this space, we've done close to $22 billion worth of project consulting, 22 billion. Now, while we have researched such large quantum of projects, it gives us insights. It just gives us some nuances. It just makes us understand what's going on in the area, what's going to happen in this area, that things should stay good or they should get better. So that research we do for the developer is critical to the existence of our business. Because when we sell properties, which is the second part of our business, we do share a snippet of that research. A concise form of that research we share with our clients, so our clients are making informed decisions. And because we help these developers buy land at a right price, we are able to provide the end product, which is the apartments or units or whatever, these to our clients at a discount to the market. So bottom line, anytime any client buys anything from us, he's not paying a market price. He's getting a wholesale price, which is traditionally 8 to 10% below the market price because of the economy of scale that exists there. Now, the third important thing is, I know there might be some first-home buyers on the Zoom tonight as well, which is great because you're starting your journey. And I hope you're starting your journey early, not waiting for many years before you're getting into the property market. Whether you're a first-home buyer or you are an investor, it's a large amount of money you are spending to buy something. And you don't want to buy it just because you want to live in there. You want to buy it because you want this to grow in value. And this becomes a platform for you to do more things. Imagine you buy a property which goes up in value by $100, $150, $200,000. You might be able to buy a bigger house then, or be able to buy another property then. Or if it's giving you cash flow, then it's giving you an income. It can create opportunities out there. And to ensure first-home buyers and investors are equally well treated, we try and price these properties so they become cash flow positive. That means the rent from the property is good enough to pay for all the cost. Strata, council, water, interest rate, property management, all of that. If we achieve that, what it means is that we are able to price the product that it is beneficial. It is really more sort of lucrative for first-home buyer to buy this property rather than renting it out, because they're actually saving money. And from an investor perspective, peace of mind. You do not have to put every week X amount of money to sustain in this property, because the property rent is going to pay for itself. So this is in a nutshell what we do. Now, to get back into the methodology, this bag and wheel that you see on the screen here is how we carry out the research for our developers. So we look at population, we look at demand and supply, we look at demographics, we look at location dynamics, private investment, government spending, and technical analysis. These are the things, you know, in a concise format, what we look at before we actually ascertain, before we actually come to a conclusion that it is okay for our developer to spend hundreds of millions of dollars to carry out a project. And each one of them, I can go into detail and for extremely longer period of time, but I want to ensure this is the seminar doesn't, you know, go beyond a certain period of time. So I'll try to be concise and I try to be to the point out here. So let's move quickly into the actual data, and then I'll refer back to the wagon wheel as to how that stack up. I'll give you guys a second to read this slide, or a few seconds to read this slide. I hope everybody's able to see my cursor. You can see in the year 2022, the population for Telawang Grouse Hill area is around 13,800. Guess what happens? 2041, the population is almost moving at steroids. It's gone up by massive numbers, over 54,000 more people in 19 years. That number is so humongous, so huge that you cannot shield yourself from property growth. So put things in perspective. What we're saying, when I say we saying, this is the data from the government sources. This is the only source of data in Australia produced by the government for their own use, for building up new roads, for upgrading the stations, to put a new school, to put traffic lights. This is the kind of data they look at and they produce. They've been doing this for the last 100 years. To the point, I'm sure some of you clever people will be able to pick up the wrong spelling of Telawang here. Yeah, some of you might be able to pick that up. That's because the government in their own sources is still using the Aboriginal spelling. It hasn't changed it. So that gives you a guarantee that this is straight from the government sources. We haven't made any changes to it. But hang on, 50,000 plus more people in 19 years. You know what that means? Run your imaginations. Run your imaginations and try and imagine 2 times people living in Parramatta CBD. Think about all those apartment buildings, townhouses, villas in Parramatta CBD. 2 times of that, double that, living in this area in merely 19 years. Parramatta is over a 200-year-old suburb. It took that suburb with all that infrastructure, all that job creation, all of that that they've done so long to get to a population of 21 to 22,000. More than double of that amount of people are going to move in this in merely 19 years. If that doesn't create demand, I'm not sure what will. So that we've ascertained. So I've given you the demand side of demand side in Rouse Hill. Now, when we look at this curve, you can see these bars. This is population going upwards. So really by 2028, population is going to be more than doubled in Rouse Hill, more than double in the next 5-6 years. That's going to create a lot of demand. The gray bars that you see here, my cursor, that's a supply, because we want to work on demand and supply. Now, each bar that you see here, for example, this one, the gray one, that's actually reflecting every single house, townhouse, apartment, villa, boarding house that can be allowed to be built. Mark my word, that can be allowed to be built in Rouse Hill. Not necessarily it will be built. That what is allowed. So we've captured the total population increase the government is saying, and the total supply that can come in a given year. Now, which is beautiful, because once we have that data, we can analyze to see, is it going to be oversupplied or undersupplied? Comes my favorite ratio. I hope I'm not boring some of the guys who are here and heard about this, but it is a very critical piece of data. Average household size. Now, this is beautiful. You guys can see this. The average household size is 3.48. And it is going up to 3.53 in merely next 4 or 5 years. Now, what is average household size, and going up means what? Let me explain this. I'm going to come off the screen just to make a point of it. So I hope you guys can see me now. So what is average household size? It's very simple. Imagine there are 10,000 people living in the area in Rouse Hill, and there are 5,000 properties. That means apartments, villas, houses, everything. 5,000 properties, 10,000 people. What is the average number of people per property? 10,000 people, 5,000 properties. Average number of people per property. Any of you guys want to type that number in the chat or just mention it? 2. Amazing. There's some quick fingers out there. Fastest finger, 2. I hope everybody got this. It's very simple. 10,000 people, 5,000 properties, 2 people per property. But guess what? If we increase the supply now, just to do a test of it, and make the properties to be 10,000, now there are 10,000 properties and 10,000 people. That means 1 person per property. Everybody got that? I hope. What happened here? Because we brought in too much supply, the average household size dropped from 2 to 1 because the population didn't go up, but too many properties came in. So it dropped from 2 to 1. But what government is saying to us is average household size is not dropping. Average household size is moving upwards. It is actually going up from 3.48 to 3.53. But what is even more important is today in Rouse Hill, Tallawong area, you got a lot of people. Almost 65% of people or more are living in houses because traditionally they were houses. Okay. Now the beauty is going forward, there aren't many houses coming in. The land is depleting. So you're going to have studio, 1 bedroom, 2 bedroom, 2 bedroom study, 3 bedroom, those sort of dwellings coming in. So despite the fact you got smaller properties coming in, the average household size is moving upwards because traditionally, because smaller properties are coming in, it should drop. 1, it is moving upwards, and 2nd, it is moving upwards despite the smaller properties. That is a very, very significant piece of data. That really ascertains that there's going to be tremendously more demand than the supply. And last but not the least is the dwelling occupancy rate. Simple terms, this is a data that tells you how popular this suburb is going to be. If you believe Rouse Hill is a popular suburb today, forget it. When you enter 2026, as the time goes by, the popularity is increasing. 81.51, 84.01, and so forth. It continues to become more sought after suburb. That's really what it means. So this is some very, very relevant data. Not just that, while the population is increasing, as the analysts, as the researchers or the consultants for the developers, we want to ensure that right kind of people are moving into the suburb. It isn't just natural birth that's taking place. If there are babies getting born, too many babies getting born in the suburb, it's a good thing for the suburb, but not so good for the investor or property owner, because that's not creating the demand for new properties. But when people in the age bracket of 24, 25 to 39, that age group of people moving to the suburb, they need properties, either to rent out or to buy to live in. And that is going to trigger more demand. So we've looked at that data itself, that over the next 5, 7, 10 years, there's going to be a lot more demand created by the people who are in the age bracket. And it's not surprise. We sold in excess of 32 properties in last 10, 12, 40, or rather 16, 18 days. And when we look at the age bracket of these people, majority of them are falling in this age group. Either they are first home buyers or they're people who have done tremendously well and buying the first investment, and they are 35, 36 years old. So this data is critical data. Again, government is providing this data, so there's value in looking at it. Another set of data that we look at is what kind of people. When people are moving in a certain age bracket, are there more single people moving in? Are there older people moving in? And that sort of stuff, because that helps us design the project or product. Because think about it, this developer is doing such a large project. Should he have more 3-bedders? Should he have more 2-bedders? Or should he have more 1-bedders? You don't decide that on your hunch. You don't just sit out there and draw a lottery. You want to be driven by the data, demand, and the genuine desire for those sort of dwellings. And the government provides that insight that, hang on, over the next 14, 15, 18 years, large chunk of people moving in here will be couples with dependents, 1 or 2, and couples without dependents. And that's the reason that we've gone out there and have created product which is relevant to that sort of demand. More 3 bedrooms and more 2 bedroom and 2 bedroom plus study, or larger size 2 bedrooms. That's exactly what we've done. We've ascertained. So let's say this. We have actually got a few things decided, or few things been established. One, population is going up tremendously well, massive increase. Supply is controlled, and we know that a certain age bracket, 24 to 39, that's the largest category of people coming in. And traditionally, they're going to need more 2 bedrooms or 2 bedroom study. That's a more sought after product in there. Now we want to look at the affordability. Are these people able to afford this sort of product? And what is the nature of it? Are there more laborers coming in, technical people working in retail, and so forth? This is now demographic data that I showed you about on the earlier wagon wheel. Last census shows us that majority of people who are moving in this suburb are professionals. Now, I'm not biased about the other category of people, but because when I wear my investment hat, I love professionals, because professionals have jobs. They traditionally don't lose their jobs very quickly. And if they do, they get another job very quickly, right? So professionals are high income earners, and professionals have higher education. We've seen when more professionals move into an area, the area transforms, it gentrifies. You see more eateries and stuff coming out. You see the schools getting transformed because of professionals moving in. So this is another beautiful set of data leading up to now. We get that more professionals are moving into Rouse Hill in the last 5 years than any other category of people, which is great. It is again reconfirms the fact that more people with bachelor's and higher degree are moving into this suburb than any other qualification. So more educated people, more professionals moving in, that can further validate that these people have higher income compared to, you see the red bar? So these people have, more people in Rouse Hill have higher income compared to Greater Sydney. So more disposable income. I'm going to just come out of it and to make a point of something. So we've identified a few things here. We've identified a few things. One is the population is increasing, supply is low, and an age bracket of 24 to 39, that's what's moving in. And these people are going to need more 2 and 3 bedroom apartments to live in, or properties to live in. Also, these people are professionals. They have higher education. They're very well educated, and they have higher income. Now, if I was someone who was running a business in the area, then I will be very bullish about the business. I'll be very bullish because population is increasing, people's disposable income is increasing. That means I'll go very aggressive. I'll try and expand the business. This is again validated by what's going on in the area. What's going on in the area? Have a look. Rouse Hill Shopping Center, which is already a fairly large shopping center. It's close to $500 million shopping center. $500 million shopping center is going through an expansion. They're spending close to $110 million more in the center because they know the current shops are making too much money. And because population is increasing and people's income is increasing, we can have another 50, 60 shops and they will still make enough money. Because businesses don't expand, businesses don't spend money unless they see return on an investment, and which is very clearly evident to the shopping center guys, and that's why they're doing it. Another major infrastructure from the government's end which is coming in is a hospital. Now, why would government decide to put a hospital here? There's one in Norwest, there's around Blacktown, there's Westmead, it's got such large medical precinct. Why are they building up another hospital in Rouse Hill? Simple reason, because the government themselves is fully aware that massive population increase that's going on in here, it requires a health facility close by. So there's no pressure on the other surrounding hospitals. So that's again very clearly evident of the fact massive population is going to happen, increase is going to happen in this area. Now, there is a very lucrative infrastructure that's coming in. Right now, our project is less than 4-minute walk to the metro. We're hardly 250 meters or so from the metro. And right at the metro stop, Tellawong metro stop, there's a Tellawong town center coming up, which is going to offer 44 outlets, cafes, restaurants. You got a supermarket, you got apparel shops and so forth. So that's your go-to place, which is less than 4 or 5 minutes. So all I say is be mindful, don't spend too much money out there on coffees and dinners. But that's evident. People who are going to live in the area are going to really benefit from these sort of facilities which are mushrooming so close to our project. There's another big piece of infrastructure which is coming in. There is a ethnic grammar school, Sikh grammar school, which is coming up there. It's a $160 million project, which is coming up there. And council has already got another plan to build up another Rouse Hill Public School, which is again, there's another school, which is Telawang Public School, which is a project they are examining at the moment, which is not started or there's no date for it, but they're considering another school in the area as well. So that again justifies the fact, massive population, the government needs to provide infrastructure. This one is a bit more relevant from an investment perspective, because when such sort of schools open up, it actually encourages more community to come into the area and create demand for properties. So this is a very positive sign as well, purely for investors. Now going into the project side, so I've sort of summed it up for you: massive population increase, low supply, the right kind of people moving in, right age bracket, they got the good jobs, the professionals, high income, educated, private money is flowing in the area, government's investing in the area. So it ticked pretty much all the boxes. Now, the only thing we haven't touched upon is the property data of the area. And I'll go back into that shortly, but I don't want to bore you with the data itself. Just wanted to give you a glimpse of the project. So here is a project for you. You can see that it's around 7 to 8 story buildings. We've got here the beautifully designed. We've got 4 buildings out there. Location, again, the address for this project is 8 Herman Crescent, and you guys Google out pretty much everything that you need for your daily use is walking distance. You also have within 10 minutes drive, within 10 to, or rather 12-minute drive, you have access to close to 45,000 plus new jobs that are going to be created in there. More than 45,000 jobs within a vicinity of 10 to 12-minute drive. Norwest Shopping Center, Norwest Business Park, and all that stuff that's going out there. We're going to see massive job surge in this region, and you're going to be 10 to 12-minute vicinity of that as well. Considering the metro, which is there, you are really 2 stops away from one of those major, less than 10 minutes away on metro, on the major, from the major employment hub as well. And the universities are not too far in Blacktown, which is again around 15 minutes or so drive as well. So it basically has got all the infrastructure that you need to live in an area in close proximity. As a project, we got 4 blocks, A, B, C, D. Currently, we are selling block D, which is what we've launched on 14th of July. And there is a parkland here, which is close to 5,000 square meter of space, which council is going to build a park, which is almost going to be treated as our private park, because that's the last building, or our buildings are pretty much next to each other. In front of these buildings, there's going to be a cycling track as well as a walking track. Every single building's got a rooftop as well to enjoy the views of the surroundings. But parkland is the key benefit that we have here. What we can see here is there's a Kadajong Road here. From this point here, there'll be a staircase that's going to be built by our developer, get straight on the Kadajong Road, and here is the metro, literally, as I said, 3 to 4 minute walk from the project. Here are 4 different towers that's going to be built. This is the tower we are selling at the moment, which is Tower D. It's a very, very, very immaculate product. You got pretty much $1 million finishing product present to you in Rouse Hill in a very affordable price bracket. You got 40 mm stone. You got ample of storage here in the front. You got, LV appliances, which is Italian brand. You've got ducted air conditioning. You've got down lights, high ceiling, pendant lights. These are part of the whole offering. You got microwave there, dishwasher, pretty much fully functional kitchens. Fridge is the only thing that you need. Nicely, designed floorboards that extend from your living area. We have provided free upgrades to the bedrooms as well. The developer wanted to have the carpet. Most of our clients don't prefer carpets. We've extended free upgrade to the bedrooms of the same floorboards. These are very high quality floorboards with cushioning and so forth. So there's no sort of inflation. They absorb the water well, and it doesn't actually inflate or with the water dropping and stuff like that. Very high quality floorboards they've used. They actually did an experiment to show us the same as well. These bathrooms are very nicely looking bathrooms. I must say that. You got tiles all up to the ceiling. Again, the finishing, use of the black metal out there just to give a bit of a contrast, and some nice mosaic tiles out there. So what I would say is, what I would honestly suggest is that we got a display suite built at the site. These images are not doing the justice. Through the weekend or any of the days that you want to actually go out and have a first-hand experience of the quality of the product, you must visit the display. Please get in touch with the sales team and they'll be more than happy to show you around the display, and walk you through the site, location, fixtures and fittings, all of that stuff. But I want to focus more on the data side of it, but can't escape the beautiful balconies or courtyards that the project has got. A lot of apartments have fairly large courtyards and balconies too. I mean, you can see this particular one has got, there's a dining table out there, there's another leisure table out here, almost 20-30 people can very easily enjoy in this particular one, but each one is different. These are beautiful rooftop terraces, which are rooftop gardens where you have the barbecue area and sit down spots for the occupants to enjoy. Let's dive deep into the property data side of it. The current vacancy rate of the project, or of the area, of the Rousel area, is 3.2%. And like for many of the projects which we researched over the past and we made some predictions, we can pretty much tell you that over the next couple of months, you will see a further decline in the vacancy rate. It'll drop further. But talking about 3.2% vacancy rate is lower than the Sydney CBD 2000 postcode vacancy rate. So it's not a bad vacancy rate, but you will see a further reduction in the rental properties. This place is getting much more, coming much more in demand, and lesser rental properties will be available out there. But what's more interesting data set here is the median unit price. Now, the median unit price for the area is around 667, and median house price is around 1.4 million. Now, this is a very important data, because you can easily ascertain half of 1.4 million is 700,000. That means 50%. Now, as a rule of thumb, we want to buy into areas where median unit price is less than 50% of the price of a house. That's traditionally we want to achieve. It is not an easier equation. It is not an easier equation to achieve in Sydney these days in many places, because the cost of construction has gone up. Take an example of Blacktown. The median house price is around 950 million. The price of a apartment might be around 575, 600. So your median price of your apartment is around 550 to 600, while the price of your house is less than $1 million. So the price of a unit is typically around 55 to 60% of the price of a house in Blacktown. And many other places will be same. Many places will be same. But here, the median price in Rousel is less than 50%. It is around close to 47% of the price of a house. But what is a median price? It's very important for me to explain you the median price, because the next couple of slides that I'm going to show you will have more relevance then. So this is a median price. That's your lesson about the median price, because the media always talk about the median price being this, or it's gone up, it's gone down. So what is the median price? Let's assume in the month of July, there were 11 units sold in Rouse Hill. There were 11 sales that happened. The most expensive of the top and the cheapest one at the bottom. Put them in ascending or descending order. 11 sold. Price of the sixth property is called median. That means 5 above it, 5 below it. Very simple. What we're saying is, or not we, but what core logic, RP data, is saying the median price is 667. That means there were some sold above it and equal amounts sold below it. When we look at this data, when we look at the ones which are sold above the median price, usually they are newer, they're more brand new maybe, they're bigger in size, they're nicer finishing, closer to the station, that's why they're more expensive. And the ones sold much below the median price could be far away from the station, not walking distance, not as good quality. Maybe they are much older, 5, 7, 8 years old. That's why they're cheaper in value. Okay, because we are not discriminating. We're taking every single unit sold in a particular month to figure out the median price. Half sold above the median, half sold below the median. That number, that's how the median price is ascertained. Now that we've established what is a median price and how we work it out, we've taken some sales. So you can see here, the first property that I'm showing you, a very average looking property. You can see inside there's carpet, no air conditioning in here, sold for 650, below the median. Next one sold above the median. You can see from here, it's a bit more nicer. You got floorboards, nice outlook. You still got the oyster lights. That means it's not a high ceiling, and it is slightly older built. That means it's 2019 built, which is what the fact is. It was sold in June. Another one here, sold for 660,000, built in 2017. And you can see compared to the kitchens that I've shown you. So have a look at this kitchen. There is no waterfall. It's 20 mm, not 40 mm, not much of character in the kitchen here compared to the kitchens that I show you here. Let me just go back to the kitchen so you can see it. That's the quality of our kitchen. You can look at that. That's an integrated kitchen, beautiful looking kitchen compared to the ones that we're looking at here. Okay. But what we're going to do is going to do a very quick test. I don't want to take the most expensive property, which is sold here, 685. I want to take the cheapest property here, which is below the median price, sold for 650. Now you can see here, this property was built in 2020. That means as of today, this is 2-year-old. Our project that we're talking about is going to be ready in 2 years' time. 2 years' time. So this particular property here is going to be old by 4 years. It's going to be 4-year-old in 2024, while our product is going to be brand new in that year. At the very beginning of this particular webinar, I mentioned that for our clients, we try and achieve 3 things. One, we share a good amount of research with them, the one we've done for the builder or the developer. We share that research so our clients are making more informed decisions. Second, we try and get them product at a wholesale price, not market price. And third, we try and achieve cash flow positive properties. So I'm trying to address the second point here. This property, which is going to be 4-year-old and this sort of quality, nowhere close to us. Even this quality is not as good as ours because it's got no ducted air conditioning, no downlights and so forth. Built in 2019, built in 2020. This product at 650 is going to be 4-year-old in 2024. If we are able to provide you a brand new product in 2024 at the same price as 650, then surely we are adding value. We're providing you at a discount to the market. Let's not forget this property sold for 685 and it's 2019 built as well. I'm saying at this price point, 650, if we can offer you a product which is brand new 2 years from now, while this product is 4-year-old, and 4-year-old means you have lost $60,000 worth of tax benefits in this. This product at 650 will have $60,000 less tax benefits compared to our product. It's going to be actually even more, but minimum $60,000 worth of less tax benefits. And we're providing you a brand new product of amazing quality, easier to rent out, get a better rental. And our product has full 7-year builder warranties, structural warranty. This product has got only 3 years left. On top of that, in year 2022, which is this year, there's a new building code that has come up. So any of you guys, if you're worried about the construction quality, your big buildings having cracks and this and that, think again. Because in year 2022, the new code of construction that has come is a lot more stringent, a lot more compliant, and has a lot more insurances. That means these builders, any builder who's starting in construction from 2022 onwards, has to comply with a lot more stricter norms. So surely the buildings starting from 22 onwards are going to be much better quality. That's one. But I did mention we do wholesale pricing. So really speaking, we are at this point of time able to offer you product below 650. A limited amount of product we have, which after rebate, your net price will drop down below 650. And it is going to be brand new in 2 years' time, while this product is 4-year-old. I could have taken this example of 685. That would have made it look like our product is more than $40,000 cheaper than this product. More than $40,000 cheaper than this product, and ours brand new, while this is going to be 5-year-old in 2 years' time. So there's genuine value. We've done some comparisons with the competitors who exist. There's only one or two who are worth comparing because the quality is as good as ours. Our product is close to 8 to 10% below the brand new properties that exist in the area. And that's your equity built up on the day one. So you do not have to rely on the market movements. You are buying. This is what can happen. If you buy the market price, I hope everybody can see it. If you buy the market price, you're hoping for your property to go up in value. That's how you make money. But hang on, if you buy below the market price, you already made money. You don't have to wait for the market to go up. And that's exactly what we're doing. Third bit is cash flow. And don't forget, this is the quality of product that we are looking at, cheaper than the market. I've done a basic cash flow here just to give you guys a glimpse of. If you buy a product which is going to be net price to you 645, I do have some properties below 645 for a limited period of time. Our property price is starting from 660 onwards, but then we're doing some rebates at the moment for a limited time for our clients. So I've not taken the example of the cheapest 2-bedroom, 2-bathroom, 1 car park storage. So please, again, 645 is not about 1 bedroom. This product we're talking about is 2-bedroom, 2-bathroom, 1 car park, and a storage. Minimum 77 square meter internal, maybe 10 or 15 square meter balconies. Then the car park is separate. Just internal area of the apartment is minimum 77. So let's take an example of a product which is worth 645. I do have something which is cheaper than that as well. So you can see there's a genuine value being built. Even if you borrow 90% from the bank to buy a product like this, a lot of you guys will only be borrowing 80% LVR, but even at 90% LVR, and if you are a first home buyer, you won't be paying stamp duty because it's under 650 and we can work it out. But if you're an investor, then you pay stamp duty of 24,000, total commitments around 89 grand. If you look at a conservative rent of 560 per week, okay, your total income for the year is around 29,000. You put all the other costs, interest payment of 3.75, your rental management, your landlord insurance, your strata, council, water. You put all these costs through this rental income, which is going to be, I can tell you, the rentals in these areas will definitely go up in next 2 years. But even at a rental of 560 on a conservative basis, from this income, when you take out all these costs, you have to put $14 before tax to sustain this property, which is minuscule, $14, okay? But the beauty is, if you are an investor, you will claim minimum $15,000 worth of tax benefits in the year one. It'll be even more than that. But even at a $15,000 tax benefit, at a 37% tax rate, your net position is going to be 5,600. That means you are actually going to make money from this property, from the taxman. Let me break it down into 2 parts quickly. This is the last slide. So please, if I can have everybody's attention, this is very important data. If you're a first home buyer, let's go and hit the first home buyer. If you're a first home buyer and you buy something for 645, all you need is 10%, which is 64,500. You don't pay stamp duty. If you are a first home buyer and you're renting in the area, then you lose $29,000 a year. But if you are a first home buyer and decide to buy a property, because this is cheaper than the market, you buy the property, you already made some capital gains of 50, 60 grand. But what happens to your cash flow? If you were renting, you would have lost 29,000. Since you bought at 3.75% interest rate, you don't lose even $14 because you're not paying rental management of $1,100. You're not taking landlord insurance of $400. So you're actually saving $1,500. You're actually saving $1,500 by living in this property rather than renting it out. On top of that, you bought a property which is genuinely in the market worth around 695, 700 at much discount to the market. You're putting in 50, 60 grand, you already made 50, 60 grand, and you're paying less every year compared to your rent outgoings. And if you're an investor, it's no brainer because all the costs surrounded by around this property is paid by your rental. And in the end, you go to your taxman and you say, Mr. Taxman, I bought this property, borrowed 90%, rent of 560, paid for everything, and this is my depreciation schedule. He's going to look at it and say, hang on, the rent paid for everything, so there's nothing. On top of that, you got $15,000 to claim in tax year one. If your income is 90,000, he's going to go 90 minus 15, 75. You should have paid tax on 75. So all the extra tax you paid, you're going to get it back. Now you got an income coming from the property already. You're making $100 every week for owning the property. This is a very strong way to build wealth. Why? Because you tick 3 boxes here. You bought in a suburb with extremely strong fundamental, massive data, massive research, massive amount of demand building up in there. You bought in the suburb cheaper than 4-year-old properties, cheaper than that. So you already got a massive discount built in there. So there's an equity that you built. So you attained a bit of capital value there already, 50, 60,000. On top of that, you bought an asset where the rent is so strong that it pays for itself. So really, other than putting your initial 89,000, which is the stamp duty and the 10% deposit, there's nothing. That 80, 90 grand from your pocket is giving you close to $5,600 back. That's around 8 or rather 7%, 7 to 8% return on your own money after tax. So you're actually getting 8% return on your $90,000. Okay. That's the amount of money you're getting back. So this is, I hope everybody's getting it. This is a very simple way of getting started in the property. Very simple way. Because the beautiful part is, yes, you're putting the 10% deposit, but then that money is coming back. You're getting 7, 8% return on your money. You have a property which has already got $50,000, $60,000 worth of equity, and it's in an area with extremely strong fundamental. This is how you create wealth over a period of time. But what would happen is a property like this will become the stepping stone for you to do more investments or buy more properties or buy a bigger property, because it's no cash flow. Whatever you're earning in your salaries, whatever you're saving in your salaries, you're still doing that. It's not impacting that. It's not impacting your cash flows. You're still living your lifestyle. So you're saving some money every year. You're getting extra $5,000, $6,000 every year. You're saving that as well. Come 3, 4 years, you already have some deposit. You go to the bank, you already got the equity built in there, because this property is worth not 645, it's worth 700 in the market. And guess what? There's inflation. Cost of construction is going up. And in 3 years, 4 years time, it's going to be at least 15% more, because current inflation is 6%. In 4 years time, that means 24% increase in the cost. I'm saying 15%. Even at 15%, that means this property after 4 years, if you come back to Rouse Hill, come to the same builder and say, build me a building, he's going to say, my cost of construction has gone up. He has to sell it at 800,000. What is your loan? Let's say you didn't pay any principal. Your outstanding loan after 4 years is 580,000. I hope everybody get it. That's your loan, 580, 500. Same property is going to be worth around 800,000 after 4 years. So you got $220,000 worth of equity built in. 220,000. That's a lot of money for doing nothing other than making a smart decision. On top of that, you're making money every year coming in. Every single year, you're getting the cash flow out of it. This is how people slowly build wealth or build multiple assets or build a portfolio, by cautiously investing or buying in areas with strong fundamentals below the market value and buying assets that pay for themselves, so you don't have to put your hand in the pocket every week to sustain. That's why we've chosen this product, and that is why over 33 apartments been sold in less than 18 days in this particular location, because most of our associates or people who've been working with them, they're buying for their kids or for themselves as an investment, because they can see the value in this product. So that's really for myself on this particular project, in terms of the research, in terms of what this product is about. But I strongly recommend you guys that coming Saturday, the complete team is going to be at the display, which is 8 Herman Crescent. It's a small display, but good enough to give you a good feel of the kitchen, bathroom, the living and dining area, how the look and feel of this product is going to be. You get to see the first-hand experience of the location as well. And if you want to come in and get more questions answered or know more about the research, we'll have a lot more data to share as well. So that's something we can do that. So strongly recommend you guys to visit us at the display to get a better understanding of the product or get a better look and feel of the product. But those of you who have been to the display or have seen the product and want to move forward, the process of procuring, the process of buying this property is very, very simple. We have all the floor plans, floor plates, aspect, pricing, all of that's available with the sales team. Please do get in touch with the sales team, people who have invited you to the tonight's Zoom. They'll be able to show you the different layouts and share some information about the product and so forth. If you like a particular layout or a particular apartment, then you can hold it. Today we are, I believe, Wednesday. You can hold it for the next couple of days until you come to the display and have a look at it and be confident and comfortable with the product. After that, if you decide to move, then we will issue the contract. To hold an apartment, you need to put in $1,000, fully refundable. Fully refundable, that money sits in a trust account. And if you decide to proceed, then we issue the contract and you go through the contract with your conveyancer or solicitor over the next 7-8 days. Once you sign the contract, then post that you pay the 10% deposit. If you change your mind or if circumstances change or you are not able to proceed with the contract, we refund your $1,000. We don't want to keep your money if you're not proceeding with the product. But I strongly recommend you guys to get in touch with the team, because it's an obvious thing that the cheapest apartments will go away fast, especially if you're a first-home buyer and you're looking for closer to $650,000 mark, so you can get the full value of stamp duty rebate. Imagine if you're buying it for $650 or under $650, you saving $24,500. That's massive amount of savings. And then we're offering a rebate of up to $20,000 on a 2-bedroom. So you're already better off by $45,000. That's a lot of money. And you're only putting in $64,000 or $65,000. So you've already made 80% of your capital that you put in. So there is a massive opportunity for first-home buyers out there to take advantage of cheaper units, and investors obviously can look at the better units, whatever layouts or sizes that suit them best from a rental perspective or from the capital growth perspective. But once again, thank you very much for coming in onto the Zoom and listening to the research around the area and why this developer is taking up this $200 million project. Surely there's enough research and data that has given him the confidence to go out and indulge in $200 million investment. I believe and I hope that I've given you enough information tonight for you to make your own smart decision worth $600,000 to $700,000, because based on our data, the developer was happy to make his $200 million decision. Once again, thank you very much. And if you have any questions, I'll be more than happy to take those questions now as well. You can type in, but really recommend you guys to come to the display. It would be good to meet up with you guys over coffee and also answer your questions whatsoever you have, and you get to see the product as well. Great. So if you have any question, guys, you can unmute yourself and ask the question for the better of others as well. And if you are someone who's shy, you have a chat icon at the bottom of your screen. Just click on it and you can type in the question and I'll try to answer that as well. What is the price range and the promo rebates at the moment? So the price range for 1, 2, and 3-bedroom apartment, I believe, because I'm not involved in sales, I apologize, but I would say the 1-bedrooms are just around $495 mark. The 2-bedrooms are starting from $560, and 3-bedrooms are around just around $790 mark. And the promo right now is we're offering $15,000 rebate on 1-bedroom, $20,000 rebate on 2-bedroom, and $25,000 rebate on 3-bedroom. So there are some rebates, but speak to the individual team members and they'll be able to answer all those questions around the pricing, because every unit is different based on their sizing, their aspect, what level you're buying. You obviously want to know the right price associated with a particular unit. Right. All right. If anyone else has got a question. Well, it's quite late as well. It's 8:35. So look, if you don't have any question, that's fine. Thank you once again. And as I said, as a starting point, you must visit the display. It's a lot of money involved, big decision. unless you come into the site, look at the site and look at the quality of the display, see for yourself what sort of product it is. It doesn't make any sense to make a decision. But yeah, if you want to hold a particular unit over the next day or two, so you still have that unit available with you while you make your final decision on the weekend, then surely you can do that as well. But I'll leave you to get in touch with the sales team to visit the display and have a look at the product quality and so forth, and we can go from there. So thanks once again, guys, and have a wonderful evening or wonderful night. Thank you very much.
Thank you, Vishal. Thank you, everyone.
Thank you, Vishal.
Thanks, Vishal.
Thank you. Thank you, Jill.
Thanks, everyone.
Thanks, guys.
Thank you, Vishal.
Thank you.
Thank you. Good night, everyone.
Good night.